Let's go to another video, but first subscribe and leave a like to strengthen the channel. Now, let's go.
In March 2026, something happened that most people still don't fully understand. The Strait of Hormuz, a strip of water less than 60 kilometers wide at its narrowest point, was blocked. Attacks on oil tankers, military tension, and suddenly, 20% of all the oil the world consumes stopped circulating. It wasn't a gradual cut. It was as if someone had turned off a tap that supplies a third of the planet. The price of a barrel exploded within days. Gas stations in countries that depend on imports began rationing. Airlines suspended routes. Factories reduced shifts. And in the middle of all this, something curious was happening on social media. Influencers, prophecy channels, and spiritual gurus began going viral with the same message: buy gold, stockpile food, the system is going to collapse. But while millions of people were rushing to Google to search how to survive the oil collapse, a much smaller and much quieter group was doing something different. Billionaires, sovereign fund managers, and institutional investors were reallocating capital, not to where panic was pointing, to where historical logic was pointing. And here is what most people didn't notice. This has happened before. Not once, several times. In 1973, the oil minister of Saudi Arabia announced that producing countries would start controlling the price of a barrel themselves. Overnight, the barrel went from $3 to almost $12. In the United States, lines at gas stations stretched for miles. There were fights, rationing, violence on the roads. The stock market fell almost 50%. President Richard Nixon went on television to announce the Project Independence, promising that Americans would never again depend on foreign oil. That promise was not fulfilled. But what happened to assets during that period permanently changed the way serious investors view energy crises. Because if you had followed your instinct, buying oil stocks, you would have lost money in the short term. Even with oil quadrupling, Exxon and Texaco fell because the entire market was collapsing. The obvious answer, once again, was wrong. And that is exactly where the most important question of this video begins. When energy becomes a geopolitical weapon, what actually preserves wealth, and what only seems like it will? The answer is not in prophecies. It is in the historical behavior of money during moments of energy disruption. And the billionaires who are acting right now in 2026 have already studied that behavior. They know what most people still haven't learned. In the next few minutes, we will go through 5 real energy crises, from the Suez Crisis in 1956 to the Russian invasion of Ukraine in 2022, and show patterns that repeat with a consistency that should be taught in any finance school. But it isn't. Perhaps because if everyone knew, smart money would have nowhere left to go. If you're enjoying this content, don't forget to subscribe to the channel, like the video, and leave a comment telling what you thought, and which city or country you are watching from. That helps the channel grow a lot, and bring more analyses like this. 5 crises. 5 moments when the world stopped breathing because of oil. And in each of them, the patterns repeat with a precision that challenges any narrative of chaos. It's not coincidence. It's structure. And structure can be read, if you know where to look. The first was the Suez Crisis in 1956. Egypt nationalized the Suez Canal, cutting one of the world's main oil transport routes. Europe panicked. Rationing, lines, political uncertainty. And in the middle of it all, a Greek man named Aristotle Onassis became extraordinarily rich. Not because he had oil, because he had oil tankers. When conventional routes were interrupted, whoever controlled transportation started dictating the rules. The oil existed. The problem was getting to it. And Onassis charged dearly for that. The second was 1973. We already talked about the initial shock, but what few people analyze is what happened to assets over the following months. Oil stocks did not rise immediately. They fell along with the rest of the market. They only recovered and surpassed previous levels after the initial panic passed and fundamentals began guiding prices again. Whoever entered at the wrong moment, guided by the headline, lost. Whoever waited for the market to breathe, won. The third was the Iranian Revolution of 1979. Iran, the second largest exporter in OPEC, almost stopped producing overnight. The barrel surged again, and gold. It rose from $65 to $850 over the course of the decade. But, and here is the detail almost no one mentions, gold did not rise because of oil. It rose because the Federal Reserve, the American Central Bank, had an extremely loose monetary policy. Negative real interest rates, a deliberately weakened dollar, inflation completely out of control. Gold was a response to money policy, not to the price of a barrel. This distinction is fundamental to understanding what is happening now. The fourth crisis was the Gulf War in 1990. Kuwait was invaded by Iraq, and the world feared that oil fields across the entire region could be compromised. The barrel doubled in a matter of weeks. But the war ended quickly, production returned, and prices fell almost as fast as they had risen. Whoever bet on a long crisis lost. The market, once again, punished those who reacted to what was emotionally obvious. The fifth was the Russian invasion of Ukraine in 2022. Russia is one of the largest exporters of oil and natural gas on the planet. Western sanctions created a rupture in the global energy supply. But what happened to government bonds during that period? They collapsed because energy crises generate inflation, and inflation erodes the value of government bonds with brutal efficiency. Those who had portfolios full of safety discovered that safety has an expiration date. Now combine the 5 events and look at what they have in common. It is not oil that enriches those on the right side of history. It is control of the system's bottlenecks. Transportation, logistics, distribution infrastructure, alternative routes. Aristotle Onassis did not produce a single drop of oil. He controlled the path through which it passed. And that is exactly what made him one of the richest men in the world at that moment. And there is another piece of data that few people analyze. After 1973, American automakers, Ford Motor Company, General Motors, and Chrysler, irreversibly lost market share to Toyota and Honda. Not because the Japanese had cheaper oil, because they had more efficient cars. The energy crisis did not destroy the automotive industry. It redistributed who dominated it. The losers were those who ignored the change. The winners were those who were already prepared for the world the crisis was creating. In 2026, the same mechanism is in motion. The closure of the Strait of Hormuz is not just a supply crisis. It is a redistribution catalyst. Every energy disruption in history created losers who did not see the change coming, and winners who were already positioned before the panic began. The question billionaires are answering right now, in silence, far from the cameras, is not, how much will a barrel cost tomorrow? It is another, completely different question, and that question changes everything. The question billionaires are asking is not about the price of a barrel. It's about the American Central Bank. And understanding why this is the right question completely changes the way you read what is happening now. There is a variable that determines the behavior of almost all assets in an energy crisis, and it has nothing to do with oil. It has to do with what the Federal Reserve decides to do when inflation begins to rise because of the energy shock. The central bank becomes the axis around which everything else rotates. And those who ignore this axis tend to lose money betting on the wrong asset. If the Fed keeps interest rates low and injects liquidity into the system, gold skyrockets, real assets appreciate, and the dollar loses strength. That is exactly what happened in the 1970s. The American Central Bank preferred not to tighten financial conditions, and the result was an entire decade of corrosive inflation, and gold rising more than 1,200%. Those who understood this mechanism came out of the decade far richer than they entered it. But if the Fed reacts with aggressive tightening, as Paul Volcker did in 1979, raising interest rates to almost 20%, the scenario turns upside down. Assets that seem safe collapse. And here's the story that most disturbs this entire debate. In the 1970s, agricultural land prices in the United States skyrocketed. Farmers took enormous loans, betting that prices would continue rising. When Paul Volcker raised interest rates, the agricultural market collapsed. Hundreds of thousands of families lost everything. Not because they did something wrong with the land, because they didn't see that the decisive variable wasn't the land. It was the cost of money. That blindness cost generations. In 2026, this same fork in the road exists. The Federal Reserve faces a choice with no easy exit. Let oil-driven inflation spread through the economy or raise interest rates at a moment when growth is already fragile. Either path has heavy consequences. And that is precisely why the movements of large funds in recent weeks are so revealing. Sovereign funds from the Persian Gulf, which, interestingly, are the biggest direct beneficiaries of expensive oil, are increasing positions in maritime logistics companies. Not oil producers, companies that move oil. The same logic of Aristotle Onassis, replicated 7 decades later with billions of dollars and without any noise. At the same time, managers linked to European pension funds are reducing exposure to long-term bonds. Because if inflation persists, these securities will bleed. This is not speculation. It is what positioning data shows week after week. The bond market is already pricing in a Fed mistake before it even happens. And gold is rising, but rising for a very specific reason. Uncertainty about the central bank's response, not euphoria about the crisis itself. There is a huge difference between gold rising because the world is in panic and gold rising because the market believes the Federal Reserve will mishandle the response. The second scenario is far more sustained, and that is the one forming now. But the most unexpected shift in this moment, the one that virtually no finance channel is discussing, is happening in a sector that seems to have nothing to do with oil. Renewable energy companies have been accumulating losses over the last 2 years. High interest rates, elevated cost of capital, a worn-out political narrative. Many people had already written them off. The closure of the Strait of Hormuz changed the calculation within weeks. Governments that depend on imported oil are accelerating solar and wind energy contracts with urgency that did not exist before. Not because of ideology, because of pure energy survival. The funds that bought these depreciated companies over the last 18 months are now sitting on gains that the market has not yet fully priced in. Energy crises do not destroy value. They redistribute and transfer value from those who are in the wrong place to those who are in the right place. And the right place is rarely where the headline points. So what should you do? That is the question everyone wants to answer urgently. And it is exactly this urgency that usually destroys wealth during moments of crisis. The first lesson history teaches is not about which asset to buy. It is about what not to do. Do not panic. Do not liquidate positions at the worst possible moment. Do not follow the emotional narrative that is going viral on social media. In 1973, those who sold stocks at the bottom of the market and bought oil at the highs lost on both sides. Those who stayed quiet and waited for the market to find a new balance came out in much better condition. The second lesson is about where smart money actually goes. Not to the commodity itself, to the infrastructure that moves the commodity. Ports, storage terminals, maritime transport fleets, alternative pipelines. These assets do not appear in newspaper headlines. They do not go viral. They do not generate dramatic content on social media. But they are the ones that capture value when the distribution system is forced to reorganize. The third, and perhaps the most counterintuitive of all, is to watch the central bank before moving any piece. The response of the Federal Reserve in the coming months will determine whether gold continues rising or reverses, whether bonds bleed more or stabilize, whether the dollar weakens or regains strength. No asset moves in a vacuum. All of them respond to the cost of money. Those who understand this first have a huge advantage over those who are looking only at the price of a barrel. The fourth lesson came from a collective mistake that few like to admit. In the 1970s and 80s, thousands of people made financial decisions based on certainties that were not certainties. The certainty that oil would only go up. The certainty that land would only appreciate. The certainty that the government would not change the rules in the middle of the game. All these certainties were destroyed, and the families who bet everything on them lost everything. The market rarely punishes ignorance immediately. It punishes, in a systematic and ruthless way, the arrogance of believing the current scenario will last forever. In 2026, the dangerous certainties are different. The certainty that oil will remain scarce for years. The certainty that renewables will dominate the market quickly. The certainty that the dollar will collapse. None of these statements are necessarily false, but acting as if they were absolute truths, without considering alternative scenarios, is the same mistake under a different name. What separates investors who come out richer from an energy crisis from those who come out destroyed is not privileged information. It is positioning without excessive leverage in assets that work across multiple scenarios. Logistics works if oil rises or if the conflict lasts months. Renewable energy works if governments accelerate contracts out of strategic necessity. Gold works if the Federal Reserve makes a mistake. None of these bets requires a single scenario to be confirmed. And here's the final point that ties everything discussed in this video together. The revelations, the prophecies, and the collapse gurus are not necessarily wrong about the diagnosis. The world is in a moment of real rupture, but they are completely wrong about the response. Stockpiling food and buying physical gold under the mattress is not a financial strategy. It is an emotional and understandable response to a completely legitimate fear. But fear is not strategy. Billionaires are not afraid. They are calculating. They are looking at the map of the global energy system and identifying where the flows will reorganize. They are positioning capital and assets that capture that reorganization with a cool head, without urgency, without needing to go viral to appear right. The crisis of the Strait of Hormuz in 2026 will pass. All crises pass. What does not pass is the difference in wealth that opens between those who reacted blindly to panic and those who knew how to use that same panic to position themselves better. Follow the billionaires, not the revelations. If you made it this far, you are already ahead of most people. Don't forget to subscribe to the channel, like the video, and leave in the comments what you thought about this analysis and which city or country you're watching from.